Hey guys, Teri here. So I wanted to talk to you quickly about your taxes. I get questions about that all the time, and given that I was running around on December 31st like a chicken with my head cut off, trying to make sure that I had everything in place for my taxes, I figured it'd be good to do a video with you guys now for your taxes. So let me first answer a couple questions that I often get, and then I want to give you some tips on how to lower your taxes as you build your business. So, questions. First question I get is, Teri, should I trade as an LLC or trade as a personal investor? And my answer is, I think you honestly, in the beginning, should trade as a personal investor, because a personal investor, you get to write off any losses. And let's be clear, when you're first learning, you're gonna have some good days and some bad days. So if you do have a loss at the end of the year, you wanna be able to take advantage of that and write it off of your taxes. You can do that as an individual. Another benefit of being an individual as a trader is that your fees are lower. So you know how we see the ticker symbols run across the screen on the CNBC channel, and you see the most up-to-date stock prices? That's actually called data. And the brokers are getting that data from the stock exchanges. So like the New York Stock Exchange is feeding that data to your broker, and then your broker charges you a fee for that. When you are a professional trader in an LLC, they can charge you a lot higher fees to get access to that data. And you being able to trade at get in at $100, and somebody else with slower data getting in at $110, that can make a huge difference in your portfolio. So the brokers know that data is important, and they can charge you as an LLC a lot higher fees. So I say, in the beginning, just trade as an individual. You can avoid some of those fees as well. Another question that I often get about taxes is, Teri, should I, do you get dinged more as an active trader than a long-term investor in your taxes? And the answer is, when you're a day and swing trader, you just get charged your regular income tax rate. So if your income is less than $35,000, then you're going to get charged at the lowest tax rate. If your income is higher than $100,000, you're going to get charged at the higher tax rate. And let me give a disclaimer: I am not a tax expert, so please go talk to your CPA and your everybody else. I'm just telling you what I've done and what's worked for me. So I do know that when you're day and swing trading, you're charged at your regular income tax rate. And you can go and Google and figure out what the income levels are for each tax rate, because that's where you'll fall. The reason why sometimes people think that as a long-term investor you're charged less in taxes is because I think that the cap for long-term investing is 15%, but hey, it's really what your goals are. Do you need money to just sit in there so that you can be charged 15% in taxes? Or do you want to use the money right now and then just get charged at whatever your income tax rate is? I mean, to me, it's the same as saying, do you want to raise at work or not? Because if you're gonna get a raise at work, you're still gonna be charged income tax on it, but you made more money. So I think you want to make more money. Don't worry about the tax rate. But anyway, so that's two thoughts on common tax questions that I get. Now let me give you guys some really cool ways to save money on taxes when you are making a lot of money. So these are things that I found out which are pretty cool. First of all, if you are an active investor, you can change your accounting to MTM accounting, and they will actually let you report your income like a business. What do I mean? So MTM accounting is called mark-to-market accounting, and look it up. It's a special designation with the IRS, and it does take like a year to be approved. You have to apply for it this year, and you can't really use it until the next year. But what's really cool about it is, because I've applied for MTM accounting, now I can write off all of my trading expenses like regular business expenses. So whether that's if I had to buy a new computer, or I trade on my cell phone, if I had to buy a cell phone, or if I have fees from my brokerage company, I can write all of that off because it's a business. So look into MTM accounting if you get to a point as an active trader where you really are looking for some savings. Check that out. Another thing that we did for me this year is we switched my businesses over to an S Corp, and then we later switched it to a C Corp. So let me give you some ideas on both of those. an S Corp, one cool thing about that is I was able to pay myself. And you do have to pay payroll taxes when you pay yourself, but you also have some other advantages that you can talk to with your CPA, like I think it's called PAT. Like I'm not an expert, but I'm just telling y'all what we did. The cool thing, let me just stick to the cool thing about the S Corp is that I was able to pay myself. And one of the things I found this year is I really struggled as an entrepreneur with like simple things like getting a mortgage or applying or being able to qualify for an apartment because I didn't have a pay stub. And so as an S Corp, I was able to start paying myself, and it also helps your taxes because you can do payroll taxes, but then other parts of your account you don't have taxes on. So it's kind of cool. Talk to your CPA, but it was a cool thing for me. But then my accounts kept growing, and we were like, oh shoot, we should actually be a C Corp. And one of the cool things about a C Corp is is only charged 21% for their tax rate. Now, when you take money out of that account, so later if I have to take a dividend, I'm also going to have to pay a tax on that dividend. So I'll have to pay another 20%, I believe. So I pay 21% up front and 20% later. Check Google it, check it out. But the point is, you have to pay another percentage when you actually take the withdrawal. But for me this year, I have a large sum of money that my company brought in, and we needed to tax that at a lower rate. You can actually put that into a C Corp as a management company fee or maybe a licensing fee for your trademark. Check it out with your CPA, but there might be some ways to actually have money in a C Corp that is taxed lower. And then down the road, when you are taking the money out, yes, you'll be taxed again, but it's about your cash flow. Do you want to be taxed at 37% right now and have all that money go to the IRS? Or would you rather be taxed at 21% and be able to use that cash for cash flow, but then just later on down the road, you have to pay more money on it? So something to consider and think about, but you can definitely talk to your CPA about it. And we had to think through this as a team. Another thing that you can think about is a donor-advised charitable fund. So one thing that was important to me this year is I really wanted to pay my tithes. 10% of everything I had made, I wanted to pay. But I decided that I wanted to give some to the church and then some to other organizations. But by the end of the year, I didn't know which organizations I wanted to give to. A donor-advised charitable fund, and the only one I really know about is from Fidelity. So you guys can Google Fidelity's fund. They allow you to fund that account at the end of the year, and then later on you can tell them what charity you want it to go to. So if you think about I know Jim Cramer has like a charitable trust that he trades and then is able to later give money to different corporations. That charitable trust would be something that I think can fall under this donor advised fund. I very strongly considered this one because, like I said, I knew that I wanted to give 10%, but I just didn't know who all it would go to. So this was a really cool addition that you guys can check out. Anything else? Oh, and one last one that I would say is check out a solo 401k. But there's a difference. There's one that's managed 401k and then one that's a self-directed 401k. I like the self-directed one because the self-directed one allows you to invest in whatever you want to invest in. And y'all know I'm an investor, so I'm not trying to have you put me into some random Vanguard account. I want to invest in some good stuff. So one of the things that they allow you to invest in with a self-directed 401k, solo 401k, is real estate. So this could be a way for me to also invest in real estate from my retirement account. So this was another thing, but self-directed solo 401ks have a lot of paperwork and they take a lot of time. So at the end of the year, we were scrambling trying to see if I could even open this in time to make it work. And this is another one that you have to fund by the end of the year. There's some retirement accounts, like I think the SEP IRA, you can fund that up until April. But this one with the solo 401k, you had to have at least opened it before the end of the year for you to put the money into it for tax time. All right, so those are some ideas for anybody trying to figure out ways to lower your taxes, like I was. And let me just give you one last piece of advice. So one other thing that I learned this year during taxes was it doesn't always make sense to spend more money in order to lower your taxes. So we started tax planning earlier in the year. Like this summer, I started planning for my taxes. But around December, we realized that, wow, your tax bill is really high. And one of the options was, well, you can go buy some more stuff for your business and that will lower your taxes. So one example was, well, Teri, if you go buy a car, then you can write that whole car off and then it will lower your taxes by $12,000. Like let's just say that the car was $40,000 and I paid 37% in taxes. So let's just round, let's say 12,000. I could write that off and then 12,000 of taxes would come off. I'm just trying to think of numbers out the top of my head. So at the end of December, we're trying to think of all this stuff that we can go buy and pay for. But at one point I stopped and I said, but Teri, why are you trying to pay $45,000 just to lower your taxes by $12,000? You still have $45,000 coming out of your account. Does that really make sense? And I had to stop myself from just thinking, oh, I can spend on whatever, it'll be discounted because I have lower taxes. No, you're still spending money. Like it's still money coming out of your own account. So I stopped that. I didn't get a new car. Some other stuff we were thinking about buying. I was like, you know what? Let me just pause because I honestly would rather pay the amount that I was going to pay in taxes then buy all this stuff just to avoid paying taxes. Like it just didn't make sense. Like paying $45,000 to lower your taxes by $12,000 just is not smart. I think that I had the wrong mindset. So that's something that I would also encourage you, like really think about how much money is coming out of my account just for me to say I'm lowering my taxes. And don't go broke lowering your taxes. My mom and I call that going broke saving money. We see so many sales and discounts, but at the end of the day, you end up buying a ton of stuff talking about this was on sale. But you just spent $500 on stuff on sale. You still spent $500. Anyway, I digress, but I will talk to you guys later. I hope that this has been helpful for your taxes. All right, bye guys.